Welcome back to my class. Today in this chapter stock valuation and stock market equilibrium, we're going to be talking about exclusively how to find stock price using different models. So in this chapter we're going to be talking about stocks, stock markets, stock price, stock return and intrinsic value of a stock. We'll also compute the price of common stock using dividend discount model and corporate valuation model. We're going to be talking about preferred stock and its valuation. I'll talk about stock market equilibrium, and finally I'll talk about the concept of the efficient market hypothesis. So after watching this video, you'll be able to understand how stock markets work, understand how stock price depends on future dividends and dividend growth, be able to compute stock price using dividend discount model and corporate valuation model. You'll understand how growth opportunities affect stock price, be able to compute preferred stock price or value, and you will be able to understand stock market equilibrium, and finally you'll be able to explain the concept of market efficiency. So let's get started. So first of all, common stock. So what is common stock? Basically, common stock is ownership shares or equity in a publicly held corporation. So basically, common stock is it has cash flow rights and control right. So basically, these are residual cash flow rights and control rights. It has no maturity, so infinite life. If you have common stockholders, you have voting rights. If you are not able to attend annual meetings, then you can assign somebody. You can give your share your voting rights to somebody else or someone else to cast your votes on your behalf. And there are classes of stocks. Basically, if you use dual class stocks, could be A class or B class, and these differences basically in these different class of stocks there is a distinct voting rights and dividend payments. So basically, and other rights in stock, shares, they share proportionately um, the declared dividends, share proportionally in the remaining assets during the liquidation, and also have preemptive rights, which means first shot at new stock issue to maintain proportional ownership if desired. So these are the main features of the common stocks. Um, Preferred stock. So basically, preferred stock is a hybrid security. It has priority over common stock in case of bankruptcy, in claim, and it has characteristics similar to bond and common stock. So like bonds, preferred stockholder receive a fixed constant dividend payments and must be paid before dividends are paid to the common stockholders. And however, companies can stop paying preferred stock dividends without fear of going to bankruptcy. However, they have to, if they start paying dividend, they have to pay preferred stock before they start paying dividend to common stockholders. We can use constant growth model to find the stock price, preferred stock price. So let's talk about the dividend. Dividends are not liability of a firm until a dividend has been declared by the board. Consequently, a firm cannot go bankrupt for not declaring dividends. Dividends and taxes. Dividend payments are not considered a business expense, therefore, they are not tax deductible. So basically, dividends are paid out of the net income. Dividends received by individuals are taxed as individual income. Dividend received by corporation have a minimum 70% exclusion from taxable income computation. So basically, if a corporation buys um, common stock in some other companies, then if they receive $1 dividend payments, then basically 70% of that dividend is going to be excluded from income calculation. So only 30% on only 30% corporation have to pay in tax. So 70% exclusion from taxable income computation. That's a really great advantage for corporation having uh, you know common stocks that pays dividend. Stock market primarily just we have primary market. Primary market means market in which corporation and governments sell securities to raise capital. If a company, private company, first time issuing shares, is called initial public offering or IPOs. And once securities are issued in the primary market, then they are sold in secondary market. So the market in which already issued securities are traded by investors, that is called secondary market. So the difference between primary market and secondary market is primary market is the market where first time securities are issued by corporation or governments, and the secondary market is the market in which already issued securities are traded by investors. Auction market is basically has physical location, for example New York Stock Exchange, uh, and basically auction market matches buyers and sellers, and the stock of most large firms trade in auction market. And dealer market is basically over the counter markets, and there is no centralized location, and basically they are connected by computers or telephones, and dealers buy and sell securities. And the examples are Nasdaq and most bond or debt markets, currency market, etc. Reporting stock market reporting. So let's talk about this one. It's a high price. So the price for this company, the highest price in 52 weeks is given as high, and low, so it's a 50-week lowest price. So the price in 52 weeks ranges from $9.41 to $21.89. And next one here is dividend. So pays a dividend of 34 cents per share, and this one is dividend yield is given the current price. The dividend yield is 3.1% for this company, and the PE ratio is the given the current price. The PE ratio is 8 times of earnings. So basically, this tells us investors are willing to pay 8 times of earning. Um, so a dollar earnings. So if a company earns a dollar, then investors are willing to pay 8 times of that earnings. And this one is shares traded uh, in the last day of this uh, trading days, and this one is basically ended trading at this price, which is so basically it's a close price for that date, and for that day, and then the 0.45 means that's the share price went up by 45 cents from previous day. Okay, so let's talk about the difference between debt and equity. So you know that you finished a chapter on debt value, bond valuation, and now in this chapter we're going to be exclusively dealing about equity valuation using different models. So let's talk about the difference between debt and equity. So basically, debt is not an ownership interest in the company. So creditors do not have any voting rights. An interest is considered a cost of doing business, and it is tax deductible. And creditors have legal recourse if interest or principal payments are missed. So excess debt can be lead to financial distress and bankruptcy. So if a company has a debt, and then if the company is not able to pay the interest, then it can cause bankruptcy situation. Um, Equity, on the other hand, is ownership interest, and common stockholders vote for the board of directors and other company policy issues or corporate policy issues. Dividends are not considered a cost of doing business and are not tax deductible. That's the main distinction. If you are holding debt, then debt interest expense interest paid to the bondholder is tax deductible. But if dividends are paid to common stockholders, they are not tax deductible. Dividends are not a liability of the firm, and stockholders have no legal recourse if dividends are not paid. So dividends are not mandatory. Company can start paying dividends and stop paying dividend, so it's not mandatory. If a company cannot pay dividend, it does not result bankruptcy. And all equity firm can not go bankrupt. Okay, so if a company cannot pay dividends, so that does not result in bankruptcy. So that's the main distinction between bond and equity. So let's watch this small video clip which tells us overall about this chapter, and that main distinction between bond and stock valuation.
This chapter we go on to deal with common stocks. There's a big difference between common stocks and bonds. Bonds, you know pretty well what the payments are going to be. There's a promised payment, that's the coupon payment. They promise to give you your money back at the bond's maturity date. With common stocks, you don't know what you're going to get exactly. You're forecasting. You forecast generally that you'll get some stream of dividends over time, and then you forecast that you'll sell it, make a capital gain on it. So one big difference between stocks and bonds and their values is that with bonds you have a promised contractual payment. With stocks you have something that's dependent on what happens to the company, namely the dividends. Will the company make money and be able to pay dividends? Will the stock price go up, and will you get a capital gain? So you've got more uncertainty in the case of stocks. They're riskier than bonds, generally speaking. The other difference in this thing from a calculating standpoint is that when we dealt with bonds, we were dealing with these things called annuities that we discussed back in the time value of money chapter. Back there we talked about annuities. But we also talked about uneven streams of payment. And stocks would be uneven streams of payment because when you buy a stock, you hope that you'll get dividends that grow over time. They're not constant from year to year. And then you hope you'll get this capital gain at the end. So in the stock chapter, we'll be trying to find the value. We'll be trying to find the same thing we were trying to find with bonds, namely the value of the stock, the price of the stock, or the rate of return if you know the price of the stock. But you'll be dealing with non-annuities, things that are not annuities, and you'll have a lot more uncertainty, a lot more risk in the case of stock.
So as you can see from this small video clip, there is a major difference. There are major differences between bond and equity. But since we're gonna be doing stock valuation in this class, so basically the major difference between bond and equity valuation is debt valuation or bond valuation is basically it's annuity. So you're gonna have constant cash flows, and at the end there is lump sum payments to the bondholder. However, equity valuation is a lot more different. So it's basically you're gonna be using um, non-constant cash flows and find the present value of all future cash flow. So I'm gonna show you how to compute equity value, equity price. Okay, and so equities are more riskier than the bonds. So this video clip really summarizes the main differences between bond and equity. So we also going to be talking about intrinsic value of a stock price. So basically compute intrinsic value using the dividend discount model, free cash flow model. So um, intrinsic value, basically outside investors, corporate insiders, and analysts use a variety of approaches to estimate stocks intrinsic value. And in equilibrium, we assume that the stock's price is equal to its intrinsic value. So outsiders estimate intrinsic value to help determine which stocks are attractive to buy or sell, and stocks with a price low, below, or above its intrinsic value are called undervalued or overvalued stocks. So basically, the determinants of intrinsic value here, if you see, basically, if the market is in equilibrium, the intrinsic value and then the share price, which is market share price, should be equal. Okay, so market price comes from the cash flows which is perceived by investors, and the risk which is perceived by risk. Okay, so what kind of cash flows, what type of risk is perceived by expected by the investors. On the other hand, intrinsic value comes from true investor cash flows and true risk. Okay, so this is the main distinction between intrinsic value and current stock price. But in equilibrium they must be same. If they are not same, then we have undervalue or overvalue situation. Okay, so now let's talk about stock return. Basically, stock ownership produces cash flows in terms of dividend and capital gains. For example, if you buy a common stock, you get a, if it's dividend paying stock, you're gonna receive dividend, and then at the end of the um, investment, you can sell this. You sell this stock for more or less price. In other words, you could be selling the stock uh, on the price more than you paid for it, or sometimes even less than the price you paid for it. Okay, so basically, looking this example, suppose you buy a common stock for XYZ company today at $30.29 and sell it in future date at $32.10, and then stock pays you $2.12 dividend. And so what is your dividend yield, what is your capital gain yield, and what is your total in return on this investment? So let's find out these three things. First of all, total return equals to, so as you know that you're gonna have dividend and you have capital gain, so total return equals to dividend yield plus capital gain yield. Okay, so we need to find out dividend yield, which is basically dividend at the end of the year divide price you paid. Okay, so that's going to give you dividend yield, and capital gain yield is the ending price minus beginning price divided by beginning price. In other words, your selling price minus buying price divided by buying price. That's going to give you your capital gain yield. So in this case we have 7% dividend yield and 5.98% capital gain yield. That means the price was is changed by 5.98%. Okay, and then the dividend was 7%. All right, so your total return equals to, if you add 7 plus 5.98, is going to be 12.98. So you can just separate them and find out dividend yield and capital gain yield and add them together, or you can do this both of them using this equation here. Okay, so here I have done this one. So your ending price, which is your selling price, minus your buying price, plus you're gonna receive dividend, so $2.12, and divided everything by your buying price, that's gonna give you uh, 12.98%. Okay, so that's the stock return. So this is how you're gonna estimate, find the stock return using historical information, or you're gonna use if you want to find out your stock return uh, based on your actual transaction. Common stock valuation, is basically, as you know, that value of any security is the present value of all future cash flows, all future expected cash flows. Okay, so in this case, common stock valuation also is not much different than bond valuation, except the cash flows, they're gonna be changing every single time, or maybe constant for some time, but they you don't expect cash flows being constant forever if you are if you are evaluating common stocks. Okay, so common stock produces two types of cash flows, which are dividends and capital gain, and we can use several different models to compute common stock value. uh, the most common one is dividend discount model, and then the corporate valuation model. So basically, in this lecture I'm gonna go over dividend discount model and corporate valuation model. So under dividend discount model, we're gonna be using zero growth, constant growth, and different growth models. Okay, so basically we are applying time value of money concept here in finding stock common stock value. Okay, so common stock value, basically using dividend discount model, is basically you're gonna discount all the future cash flows, which are dividends, and the expected price you're gonna get at certain time in future. Okay, so you discount those cash flows and find the stock price. So in this example, so assume that you want to purchase a stock, and then you believe that you're gonna sell this stock for $70, and the stock will pay $10 dividend per share in 1 year, in 1 year. And if the discount rate is 25%, how much you should be paying for this stock? So that's our problem. Okay, so you're gonna sell this stock, and in the meantime you're gonna receive this dividend. If your discount rate is, as of as here, discount rate is 25%, what is gonna be the price you should be paying? So basically $80 divided by 1 plus 25%, which is 1.25, equals to $64. So theoretically, the price of this stock should be $64. Alright, so but the problem is, um, we don't know what the price of the stock will be in 1 year from now. Okay, but we know that price of the stock 1 year from now is, okay, so price of the stock 1 year from now is price of the stock 2 years from now, and your dividend next time. So we know this one for sure. We don't know P2, but we know P1 is gonna be P2 plus D2. divided by 1 plus g r. Okay, so this one we know. Now if we know P1, we can find P0. P0 means price right now. Price right now is P1 plus D1 divided by 1 plus RS, which is cost of common equity. Okay, so basically P1 equals P0 equals to D1 discounted using 1 plus cost of equity plus your second cash flow is going to be your P2 plus next dividend. Okay, so just looking this one, look at this D1. D1 is your first cash flow. P2 plus D2 together is your second cash flow. Okay, so you're gonna discount those cash flows and find the present value. So there is no difference between we are just applying time value of money concept here to find the stock price. So I don't want to go over too much about this equation, but basically your price right now is you're going to be discounting all future cash flows. Okay, all expected future cash flows and the price sometimes at future. Okay, because if you buy stock you're gonna sell one day, let's just assume that, or you don't have to sell expected price sometimes in future and discount all of them. That's gonna give you present value. Okay, so as you can see that these dividends are cash flows, cash flow 1, cash flow 2, cash flow 3, you just name it, cash flow n and price at time n. Okay, so if you solve this equation, what's gonna happen here is we're gonna receive, so I'm not gonna go over too much in detail here because there's a lot of algebra work I have done here. So basic, and another assumption here is a growth, your cost of equity should be higher than growth rate. So when you solve this all this equation, your final output is gonna be this one: price of any common stock, price of a common stock is dividend 1 divided by RS, which is cost of equity, minus growth. Okay, so R minus G. So that's the price right now equals to dividend at the end of the year divided by R minus G. Okay, so this is basically constant growth model. So let's talk about three different approaches. So we're going to be talking about three different models, which are uh, no growth model, also we call zero growth model. So according to this model, we assume that the dividend, they're going to be constant forever. Okay, so your dividend 1, dividend 2, dividend 3, dividend infinity, all of these dividend, they're going to be constant. So since all the future cash flows are constant, so this one is becomes the present value of perpetuity. So if you remember from your time value of money, if you have a same cash flow coming forever, that's called perpetuity. Okay, so applying time value of money concept here, present value equals to cash flow divided by R, discount rate. So here we do the same thing. We have all these cash flows for hundreds of years, so infinity. Okay, time is unlimited here. So if you keep on extending your time and discount all of them, as this n goes to a high and high number, then we're gonna have the p basically you discount all these dividends and you're gonna receive this price. Okay, so let's just remember this one. Price of common stock is a dividend divided by discount rate if it's a constant, if it is a zero growth model or no growth model. Okay, so let's look this example. Suppose this company just paid 50 cents dividend and expect to remain same forever, and if the required rate of return is 15%. Okay, and what should be the price? So let's use present value of perpetuity formula here. So price right now equals to the dividend divided by discount rate. So dividend is 50 cents. It's just paid 50 cents and it's gonna be always 50 cents. Okay, so 50 cents divided by 15 percent equals to $3.33. So using zero growth model or no growth model, the price of this stock should be $3.33. Okay, so case 2 is a constant growth model. What does it mean is basically the dividend in future is gonna grow by same rate. Okay, so dividend 1 is gonna be your dividend right now, dividend 0 times the growth rate for that year. Dividend 2 equals to dividend 1 times growth rate. Okay, so dividend 1 times growth rate, or you can do dividend 0 times 1 plus g square. Your dividend 3 is going to be your dividend 2 times r1 plus g. So your dividend n here equals to dividend n minus 1 times 1 plus g. Okay, so basically dividend n so your dividend n here is going to be dividend n minus 1 times 1 plus g. Okay, so your dividend is growing by a constant rate. So if you have the constant growth rate of the cash flows, okay, so since future cash flows grow at a constant rate forever, the value of constant growth stock is the present value of a growing perpetuity. Okay, so we are using present value of growing perpetuity formula. Okay, so which is PV equals to cash flow 1 divided by RS minus G. In other words, since we are using cash flow is dividend for this case, dividend at the end of the year divided by R minus G. So R is cost of common equity minus growth rate. That's gonna give you the stock price right now. So this is constant growth model. So dividend is constant forever, constant growth. Okay, so it's not the dollar amount, but the percentage change in dividend is growing at a constant rate. That's why we call this model it is constant growth model. Okay, so let's do this example. Suppose same example, earlier we had 2% I mean 50 cents dividend, and we had 15% cost of common stock, or cost of required rate of return on this common stock. Okay, so now we introduce here 2% dividend increase for every year per year. Okay, so how do you do that? How do you solve this problem now. First of all, you need to find out dividend 1. Okay, your dividend 1 is basically your dividend right now times 1 plus g. So 50 cents, because just paid dividend, you're not gonna be receiving the dividend just paid, because you're gonna receiving um, you have to hold the stock to receive the dividend. So basically you're gonna get next dividend. So you buy this stock right now, you don't know the price, so dividend is 50 cents, and times 1 plus 2%, which is 1.02. So basically equals to your dividend 1 is 0.51 cents. Okay, so sorry, 0.51 dollar, so basically 51 cents. Now price 0, price right now equals to dividend 1, which is just one, this one we just computed 51 cents, and our R is 15%, and our G is 2%. Okay, so if you do this math, you're gonna have $3.92. So if you go to your first model, the price was $3.33. So if the dividend is growing by 2%, you can see that the price is a lot different. It's $3.92 now. Okay, so this is the constant growth model. Now we're going to be talking about different growth model, which is also called Gordon growth model, and also called non-constant growth model. So basically the bottom line here is the dividend is growing at different rates every time, and then maybe in future it's going to be constant. Okay, so assume that dividends will grow at a different rates in the foreseeable future, and then grow at a constant rate thereafter. So you're going to be seeing the dividend changing in different rate for certain time, and then after that the dividend is going to be constant. Okay, so to value a differential growth stock, we need to estimate future dividends in the foreseeable future, estimate the stock price, future stock price when the stock becomes on the constant growth. Okay, so constant growth, so basically that means you're going to using your second case constant growth formula, and compute the total present value of the estimated future dividends and future stock price using appropriate discount rate. So this is the three things you're going to be doing. So let's look this differential growth in a little bit more detail. Okay, so you assume that dividends will grow at any rate, so rate G1, okay, growth 1, for a number of years, and at the growth rate of different growth G2 thereafter, and maybe after that maybe it's G3, which is constant. So could be, okay, so the dividends are different, dividends are growing in different rates in the beginning, and at the end the growth rate becomes constant. So that's the dividend differential growth formula model. Okay, so your first dividend is gonna be so dividend 1 is gonna be your dividend now times 1 plus g1, and dividend 2 is gonna be dividend 1 times 1 plus g. Okay, and so in this case that this g is could be changing. Okay, so let's look the example, maybe that's going to be more clear. So dividend will grow at a rate g1 for n years and grow at rate g2 thereafter. So this one is growing at g1, and after that maybe it's the rate is g2. or maybe this first one is G1 or second one is G2. So the rate could be different, it could be changing. So let's look this example. Okay, so common stock just paid a dividend of $2. The dividend is expected to grow at 8% for 3 years. Okay, so growth rate is gonna be 8% for 3 years, and then it's gonna grow at 4% in perpetuity. So what is the stock price if the discount rate is 12%? Okay, so as you can see in this problem, the dividend here 1 2 3, so up to here the dividend is going to be different, and after that it's going to be constant. Okay, so if you remember your constant growth formula, if you have constant growth, you can compute stock price in the beginning of that constant growth, right? So basically your dividend growth start becoming constant after year 3. So you should be able to compute stock price at year 3. Okay, so basically your dividend 1, dividend 2, all the way you go to dividend n, and your expected price at that time n, 1 plus RS, 1 plus discount rate. So whereas Pn is equals to your dividend n plus 1 divided by discount rate minus growth rate. Okay, so let's look this example here. Same example we are working here. Okay, so we have 8% for 3 years and then 4% forever. Well, let's look this example here. Your first dividend is $2, so end of the year your dividend 1 is going to be $2 times 1 plus G. Next dividend is going to be $2 times 1 plus G square, and third dividend still this G is same, 8%, 8%, 8%, still same. And after year 3 the dividend is constant, 4% forever. This is the key. My students keep on missing this information here in the past classes. Okay, and I sometimes really get hard time convincing them. You already know that if you know that the dividend is constant, if the dividend is growing at a constant rate, you can find the stock price, right? So in this case you have 1 2 3 dividend, they are different, but after year 3 dividends is constant. So using constant growth formula, can you find your price at year 3? Price at year 3 equals to dividend at year 4. Okay, dividend at year 4 divided by R minus G. Okay, so you have 12% discount rate and 8% growth rate, sorry, 4% perpetual growth rate. So basically 12% minus 4% is 8%. So basically your dividend 4, which is constant for dividend growth. Okay, so dividend 4 divided by R minus G is gonna give you the price at time 3. Okay, so price at time 3. Now you have first cash flow, second cash flow, and third cash flow is actually your dividend plus your expected stock price. You have to put it together. So when you put everything together, you're gonna have this one. Price 0 is price right now equals to the present value of all future cash flow. So basically you are discounting all future cash flow. However, these cash flows are not same. So this one is your CF0, CO1, cash flow number 1, cash flow number 2, cash flow number 3. So the key here is solve from the backward. Okay, find the present value of, find the price of the stock when the dividend starts getting constant. Okay, that's the key. And add that cash flow, add that expected price with that year's dividend income. Okay, and just use financial calculator or your Excel spreadsheet to find the present value. Again, I'm just showing you this one. So basically you're gonna compute to cash flow 1, cash flow 2, and cash flow 3. Basically cash flow 3 is gonna be your third dividend plus your expected price of that year, because after year 3 is constant. So at year 3 you should be able to compute stock price. So price at time 3 equals to dividend at time 4 divided by R minus G, which gives $32.75. And these two numbers together is going to be your third cash flow. Okay, so you can do this problem using financial calculator. Basically your cash flow 1 is uh, cash flow 1 is $2.16, and you're gonna receive that cash flow one time. Okay, and then cash flow 2 is 2.33. So you put that number and go down how many times you get, just one time. And your cash flow 3 is put both cash flows, dividend and your expected price together. So you can make cash flow 3 and go down just one number because it's coming one time, and then clear and quit the calculator cash flow worksheet, and then go to NPV and then put discount rate, go down, compute price, compute NPV. That's gonna give you the stock price. That's gonna give you $28.89. Okay, so we are definitely doing here this time value of uneven cash flows. Okay, so another example here. Suppose a common stock is expected to pay $1.25 dividend 1 year from now, and the dividend is expected to grow at 30% for year 1 to 2, 25% for year 2 to 3, 15% from year 3 to 4, and then the dividend is expected to grow at 3% forever. And if the discount rate is 10%, what is the stock price? Okay, so basically you're gonna find out, because look at this one, your dividend for year 1 to 2, because your first year dividend is going to be $1.25. After that it's going to grow 30%. Okay, and after that it's going to grow 25% for and then following year is going to grow by 15%, and after that is going to be constant 3% forever. So if you solve this problem from backward, so let's look this one here, from 3 to 4, and then after 4 years, after year 4 the dividend is constant, right? So your Pn is P4 equals to dividend 5 divided by Rs minus G. That's gonna give you the stock price at year 4. Okay, so that's the key. So we have dividend 1 is $1.25, dividend 2 is dividend 1 times 1 plus 30%, Okay, so 1 plus 30%, which is $1.62, $1.625. And third dividend is your second dividend times 1 plus growth rate, so $2.03. And your fourth dividend equals to third year your dividend 3 times 1 plus g again, so in that case we have 15%, so you have $2.33. And since you know that, and then your dividend 5 is your dividend 4 times 1 plus growth, so dividend 5 actually is constant. Okay, so you know that after year 4 the dividend is constant. So can you find the stock price at time 4? So can you find the price at time 4? Price at time 4? Yes, you can, which is equals to dividend at time 5 divided by r minus g. Okay, so in this example our dividend 5 is 2.406, and our discount rate is 10%, and our growth rate is 3%, so which gives us $34.71 stock price at year 4. Okay, so basically you are finding the future cash flows. Okay, so your cash flows, they're gonna be dividend, and at the end you're gonna be selling your stock, or you're gonna be computing expected price at future date, future time. Okay, as soon as the dividend start getting constant, find out the stock price using constant growth model. Okay, so here your dividend 1 is 1.25, and 1.25 grew by 30%, which is 1.625, and your second dividend was grew at 25% rate, which gives you $2.03, and after year 3 it grew 15%, so gave you fourth year dividend, and after year 4 it's gonna grow 3% constant forever. So basically you know exactly this price at year 4 equals to dividend at year 5 divided by r minus g, so that's gonna give us $34.71. So here I have done this manually. So first cash flow discounted, second cash flow discounted, third cash flow discounted, fourth cash flow is discounted, just dividend, and the price year 4 is I have shown you separately, but this number and this number, they go together, they can go together. Okay, the same thing, you're doing extra work here. So this is the example of how you can compute stock price using non-constant dividend growth model. Okay, so let's look at an example on how to do this problem in Excel. Okay, so let's open the Excel file here. So basically your dividend for year 1 is $1.25, and your dividend in year, so your first dividend is gonna increase by 30%, so year 2 is gonna be 30%. So if you see here, if you multiply your dividend in year 1 by 1 plus 30%, is gonna give you your dividend in year 2. So dividend in year 3 is 30%, so find 30% of your year 2 dividend, so which gives you $2.03 dividend. In year 4, 3 to 4 is going to be increasing by 15%. So find dividend 4, which is dividend 3 times 1 plus g. And now after year 4 the dividend is constant 3%. So it's constant here 3% forever. Okay, 3% forever. Do you want to compute these cash flows forever? You can do that. You can do this one for hundreds of years and find the present value of all those dividends. Okay, but we don't need to do that. What we can do here is find out when the dividend start getting constant. So we found that the dividend start getting constant after year 4. That means at the end of the year 4 the dividend get start constant. The dividend is constant after year 4. So you know exactly the price in year 4. Okay, the stock price in year 4 is your constant dividend in year 5 divided by R minus G. That's gonna give you this stock price. Okay, so your dividend in year 5 divided by R minus G. R is 10%, G is 3%. It gives you $34.37. So what you can do here is your cash flow 1 is your first dividend, cash flow 2 is your second dividend, cash flow 3 is your third dividend, cash flow fourth is basically your dividend in year 4 and your expected price in year 4. So you can put together. Okay, once you find out your cash flows, then use NPV function. So equals to NPV, and you tell what rate. It is 10%, and then tell the values. The values are these. Okay, so close it, enter it, so you get the stock price. Okay, this is how you can find the stock price using non-constant growth model. So basically you're gonna be using constant growth formula here in this, because after certain years the dividend start getting constant. So you can find out the value at future date using constant growth model. Make sure you identify when the cash flow starts getting constant. That's the key. Alright, let's get back to the slide here. Now let's talk about the common stock valuation, corporate valuation model. Okay, so we also call this one free cash flow method, and this one suggests that the value of the entire firm equals to the present value of all firms' future free cash flows. So remember, free cash flow is the firm's after tax operating income less the net capital investment. So this one is the formula to compute free cash flow. So free cash flow equals to EBIT times 1 minus tax rate, which is no PAT, add the depreciation and amortization, minus total capital expenditure times plus change in net working capital. Okay, so that's gonna give you free cash flow. Once you have free cash flow, okay, find the market value of the firm by finding the present value of all future free cash flow. So basically here in corporate valuation model, you're gonna be using free cash flows instead of using dividends. That's the one difference. And once you find the total value, take out debt and preferred stock, so you can get the market value of common stock. When you divide market value of the common stock by number of shares, you're gonna get intrinsic value of stock price. Okay, often prefer to discounted dividend model, especially when considering number of firms that do not pay dividends or dividends are hard to forecast. It's a similar to discounted dividend model. In terms of the cash flows are changing. In this one, assume that at some time in future, the free cash flows start getting constant. So that also similar to dividend discount model, like I just showed you. And find out the horizon value at the beginning of the year where the cash flow start getting constant. Okay, so that's very important. So we call that horizon value. In dividend discount model we call price at time n. Okay, so let's look this example. Suppose in these dividends, in this case I have given you just the amount. Sometimes you could be given just the first free cash flow, and then second, third, fourth you have to find yourself, like dividend 1, dividend 2, dividend 3. In this case it's given, so let's use these numbers. So these are the cash flow in year 1, year 2, year 3, and after year 3 the dividend start getting constant 6% perpetually after year 3. That's the key. So you know that after year 3 the dividend is constant 3%, 6%. So you know exactly the value of future free cash flows at time 3. Okay, so it's similar to the dividend discount model. You're going to be finding the value at time 3, because after time 3 the dividends are constant. Okay, so we call terminal value or horizon value for that number, and find the present value of all these cash flows. So your first cash flow, second cash flow, third cash flow, which is 20 plus 350 together, and add the present values of all future cash flows. That's gonna give you the total market value of the firm. Okay, so this one is similar to the constant non-constant dividend discount model, except we are using here free cash flows. Okay, now and I found this because since you are given 20 million for year 3, and I have given you this fourth year cash flow, I computed using your year 3 cash flow times 1 plus 6%. Okay, 1 plus 6%, as you can see here, this 21 equals to your 6%. Alright, so what's going on here? 5, 10, 20. I think I have some typo here, so let me fix that. Alright, so basically here we have these cash flows in year 3, and your fourth year cash flow is year 3 cash flow times 1 plus 6%. That's gonna give you year 4 cash flow. Fourth cash flow divided by R minus G, that's gonna give us 530 million. Okay, so the value of all future um, free cash flows is 530 million. Okay, since after year 3 everything, the cash flows, they're gonna grow at constant rate, then in year 3 we know exactly the value, the present value of all other future cash flows from that time period. Okay, so and then I discounted all these numbers here. For example, 5 divided by 1 plus 10%, 10 divided by 1 plus 10 raised to 2. This is 20 divided by 1 plus 10 raised to 3, and then this is 530 divided by 1 plus 10 raised to 3. That's gonna give you your total value of this firm. So let me show you this one here. Using financial calculator, you can use your cash flow worksheet. First cash flow is 0. Okay, so cash flow 0, CF 0 is 0, and go down and put your first cash flow, which is negative 5. How many times you get? One time. And then your second cash flow is gonna be 10. How many times you get? One times. And third cash flow is actually together your third free cash flow plus the terminal value. So this is what I'm talking about. Third cash flow is 20 plus your 20 plus 30 to 530, so which is 550. Okay, putting together, and then once you put everything on your financial calculator, go to NPV, put 10% discount rate, compute NPV. It's gonna give you 416.94 million. That's the net present value equals to present value equals to value of operation. Okay, once you find the value of operation, if you have any non-operating assets, marketable securities, add them. That's gonna give you total intrinsic value of the firm. Since we didn't have any value of non-operating assets, then we have total intrinsic value of the firm is 416.94 million. And in the problem, if you have 40 million debt and 5 million preferred stock, take out your debt obligation and preferred stock from this total value. That's gonna give you leftover equity value. Okay, the equity value after debt and preferred stock. So this one you call intrinsic value of equity, and you divide the equity value by number of shares. That's gonna give you intrinsic stock price per share, so which is $37.19. Okay, so this is how you're gonna use this corporate valuation model to find the stock price. Let's look this Excel example again. Okay, so your cash flow 1, cash flow 2, cash flow 3, after year free cash flow 3, after year 3 the rate is going to be constant 6%. Okay, so constant 6%. So you find year 4 value by multiplying year 3 value times 1 plus constant growth. Okay, so you have this we call horizon value or terminal value, or your value at time 3. Okay, so your free cash flow 4 divided by 1, cost of capital minus growth, that's gonna give you here is 530, and then my third cash flow I'm gonna put together, which gives me 550, discount all these cash flows by in respective by 10% growth, I mean discount rate, and add them together, I have the total value of operation. Once I have value of operation, take out debt, take out preferred stock if you have any, then it's going to give you intrinsic value of equity, divide by number of shares, that's going to give you the total value, intrinsic share price, intrinsic stock price per share. Okay, so this is how you're going to use this dividend discount model, I mean corporate valuation model, to find the stock price. And you can also use here NPV function, use NPV equals to rate is 6%, 10%, and your values are these put together. So you can, it's very handy if you use Excel. It's really easy. If you use your financial calculator, it's easy, very easy. Okay, you already learned this one in your time value of money chapter. Okay, so let's continue. And if you have any question, please don't forget to ask me. This is we have been doing repeatedly, that's why I'm not putting too much time explaining this one, how to find out the present value. All right, so now let's talk about preferred stock valuation. So as you know that preferred stock is just a hybrid security. It has the characteristics of bond and common stock. And common stock basically pay constant dividend. However, dividend, if a company cannot pay dividend, you know the company cannot collapse, cannot, it does not go to the bankruptcy. So company can stop paying preferred stock dividend, but in future time they have to pay the dividend. Okay, uh, so preferred dividend basically is a stated dividend that must be paid before dividends can be paid to common stockholders. Dividends are not a liability of the firm, and preferred dividends can be deferred indefinitely. Most preferred dividends are cumulative, so any missed preferred dividends have to be paid before common dividends can be paid. And preferred stock generally does not carry voting rights. Okay, so how do you find the preferred stock value? So basically we're going to be using this one is no growth model to find the value of the preferred stock. Okay, so we are using present value of perpetuity, in other words formula, to find out the value of preferred stock. So let's look this example. So if this company just raised 4 million, um, so basically issued $4 million preferred stock with annual dividend of $5. So if the discount rate is 12%, how much should be the price of this preferred stock? So value of preferred stock basically equals to dividend of preferred stock divided by R sub PS, which is discount rate in preferred stock. Okay, so $5 dividend divided by 12% is going to be $41.67. Okay, so I'm not going to go over too much in detail because you already have done this one, is present value of perpetuity with no growth. Okay, so this is no growth formula we just did, and in preferred stock valuation we still use the same thing. So if preferred stock with an annual dividend of $5 sells for $50, what is the expected return on this preferred stock? So basically you are solving for in first case you are solving for value, second case you are solving for your discount rate. So basically just cross multiplication. So we have rate of preferred stock equals to dividend of preferred stock divided by value of preferred stock. So 5 divided by 50 equals to 0.10 equals to 10%. Okay, That's how we can find the value of preferred stock. Now let's talk about market equilibrium. So what is equilibrium? In equilibrium, the intrinsic price must be equal to the actual price in the market. Okay. So if the actual price, if the market price is lower than the intrinsic value, the fundamental value, then the stock is a bargain. Okay, stock is cheaper. So buy orders will be uh, there will be more buy orders. That means um, this is gonna be undervalued stock. So a lot of people they're gonna buy this stock. If the price is higher than the fundamental value, the intrinsic value, then there's gonna be selling pressure. Okay, so what's gonna happen is if overvalued or undervalued situation there, if it's undervalued, if it's overvalued, then there is pressure on short selling. If it's undervalued, then there is a pressure on buying. So in equilibrium, the rate of return in the stock or the price of the stock, intrinsic value and the market price, they're going to be similar. In terms of return, in equilibrium, a rate of return for the expected rate of return, okay, and the required rate of return using CAPM, they must be similar. Expected return must be equal to required rate of return. Okay, so basically if the price is too low, there is a buying pressure, so the price is gonna go up. If the price is too high, there is selling pressure, so the price is gonna decrease. So what's gonna happen in equilibrium, the fundamental value and the market value is going to be similar. Since the price are similar, there is no undervalued and overvalued situation. The expected rate of return and the required rate of return on this stock, they're going to be similar. There is no difference in the price. That means there is no difference in the rate of return on each stock. So finally, we're going to be talking about efficient market hypothesis. So according to this efficient market hypothesis, securities are normally in equilibrium and are fairly priced, and one cannot beat the market except through good luck or inside information. EMS does not assume all investors are rational. It assumes that stock market prices track intrinsic values fairly closely. If stock prices deviate from intrinsic values, investors will quickly take advantage of mispricing. So as I explained earlier, if it's undervalued and there is a buying pressure, if it's overvalued there is a selling pressure. So in equilibrium, the price of the stock is going to be same as the value, intrinsic value. Okay, so prices will be driven to new equilibrium level based on new information. It is possible to have irrational investors in rational market. There are three forms of efficient market hypothesis. Weak form of efficient market hypothesis says that it is not possible to beat the market by looking past trends. Okay, so cannot profit by looking at past trends. A recent decline is no reason to think stocks will go up or down in futures. Therefore, technical analysis cannot be used to predict and beat the market. Okay, so the evidence supports the weak form of efficient market hypothesis, but still, people use technical analysis um, to find, you know, the best stocks to find to beat the market up. So basically, efficient weak form of EMS says that you know it's not possible to uh, beat stock market um, by doing technical analysis. Okay, so it's not possible to beat the market. Semi-strong form of efficiency says that all publicly available information is reflected in stock price. Therefore, neither fundamental or technical analysis can be used to achieve higher superior gains. So, in other words, even you use technical analysis or fundamental analysis, it's not possible to um, have a superior gains compared to market. So basically, it's largely true in my opinion. In strong form of EMS basically says that all information, even insider information, is incorporated in stock prices. Okay, so in real life, maybe not. That's not the case. It's not true. An insider can gain by trading on the basis of insider information, and they can really make a lot of money if they can do that, but it's illegal. Okay, so this is about the efficient market hypothesis. So basically three forms of efficient market hypothesis. So the bottom line is, it's not possible to beat the market just doing different techniques like fundamental analysis or technical analysis. Okay, so basically markets are generally efficient because there are hundreds of thousands of trained analysts, MBAs, CFAs, and PhDs who work for firms like Fidelity, big firms. Okay, these analysts have similar access to all the information. So therefore, news information is reflected in the price um, almost instantaneously. For most stock, for most of the time, it is generally safe to assume that the market is reasonably efficient. Okay, so however, periodically major shifts can be there. So sometimes you can see changes in the market, significant changes causing most stocks to move strongly up or down. So these are possible things sometimes, some from time to time, but in long run, most stock and most times generally, the market is efficient. So the implication of efficient market hypothesis is basically many investors have given up trying to beat the market. This helps explain the growing popularity of index fund, which try to match overall market returns by buying a basket of stocks that make up a particular index. Important implication for stock issues, repurchase, and tender offers. If the market price if the market price of stocks fairly are fair, manage real decisions based on over and under valuation might not make sense. Okay, so if the price is fair, it's a managerial decision based on overvaluation or undervaluation might not make sense. and managers have better information but they cannot use their own advantage. So they have better information about their firm but they cannot use that information for their own advantage. Okay, so basically that's illegal. Alright, so we completed this stock valuation chapter. Yes, it's a long chapter, but we don't have a lot of calculation because all these calculations are based on time value of money concept. So we have uneven cash flows, and we compute the present value using all future cash flows and find the present value of the stock, that is the price. So thank you for watching this lecture video. If you have any questions or concern, please feel free to email me, and see you in the next class. Thank you.